Welcome to TPC. This is going to be the start of the beginner's course. This is essentially going to be a video based on liquidity and what is liquidity and why we want to use it. Essentially, liquidity is what's referred to as resting orders. There's many multiple orders or different ways to spot this out. We can consider liquidity as a stop order, meaning getting people out of the trade. It could also be limit order, like a buy limit or a sell limit, meaning when these price targets get hit, it's activating something. It's either taking you out of the market or it's entering you into the market. That's pretty much what liquidity is. It's a pool of money or a price point. And when that price point gets achieved, people are going to be entering the market or exiting the market, meaning there's a lot of liquidity. Also, a lot of money being cycled through the market during this point in time. One way on how I like to be able to find liquidity easy is starting off in the daily time frame. So when you go to your daily, this would be Monday, March 2nd. I don't know why this is here already. I guess this is where the market's going to open up. So we dropped about almost. Yeah, there's a lot of. Anyways. Okay. In this case, they're the wicks of the candle. I know these might seem random or they might seem like they don't matter, but trust me, they're very, very important. And when you have these two relatively equal highs, this is where your obvious draw on liquidity is going to be. Even in days like this, you could even target this, or this would be your main liquidity. Once price hits that, you'll know it will either reverse or push higher depending on what's going on in the market. But anyways, this is one way I would like to look for it is we have this high, we have this low. Okay, now in this case, price should have pushed past this point, but this is exactly how you use it. This is the daily. Let me just. So this is the daily. Price pushes past this high, closes, takes out these highs, closes above this wick and this candle. What price should have did on Thursday was move higher, but unfortunately we have a candle that refuses to take out the high, closes, takes out the low of the high candle, and closes lower. So the next day we would target the low. And then this becomes our new high. Price opens the next day, sweeps out the low, closes lower than the open. And then this would become our new high and low. Price went lower, closed lower. I'm expecting for price to push down here and continue down. These are the most obvious shows on liquidity. We have stack lows. We took out this low. We took out this low, and we closed lower than the opening. It's very simple. There's not much to it. Let me find the tool here. Where's the path? Path. Right here. Okay. Essentially. Okay, we have. Let's take this fucking thing off. It's not doing that. fucking idea why it's doing this, but okay. Candle opens high. Next, say this is our day. Candle opens high. Next candle for the next day. Price closes here. We have this high, we have this low. We have price right here. Price wicks above. Why is it doing this? I hate this. Right. How to know that, let's say this is Monday, this is Tuesday, how to know that Wednesday is going to be higher is we took out this high. The next high is this. And our next low would be here. How we know that we would continue higher, not only do we have a correct sweep above the previous day high, but we have a candle closure above the opening of this bullish candle. So now when Wednesday opens up, if we get, let's say, price opens up here, we have I don't know why it keeps, what the fuck is this, bro? Don't know why it's doing this, but whatever. Let's say we get a wick above, but we get a candle closure low. And we sweep the high, but we don't close above the opening, and we close lower. Let's just say my candles are black. Let's just say my downward candles are black. Let's just say we get price close like this. Now, for Thursday, what do you think the next day would be, just based off of the explanation? Being that this is our new low, and we swept above here but closed below the opening. The next day would, here we have the perfect example. 1, 2, failed, closed lower, closed lower, took out the new low. This would be the exact same thing. We get a candle closure again. Why does that do? Boom. That would be our next day. So pretty much to use your overall bias would be the daily. You could use the 4 hour as well. Keep an important eye on what's going to be most likely swept. I mean, it's kind of obvious right here. We have these stacked lows. We have this major gap that gets inversed. We have this leg of price that gets tapped into, but that's for later. Right now we're just focusing on liquidity. Another reason why price would want to move lower, we took out all these highs. Price sweeps above, takes out. They're just wicks in the market. They're just, there's no like one way to explain it. It's just an overall explanation. It's liquidity. It's kind of like understanding the bank and institutions and how the market moves, like how the people that are actually causing the market to move. It's just once we understand that there's an exchange and we have to exchange these in order for our orders to be filled, we'll see that banks are really just seeking out liquidity so that they can move the market in the direction that they want, because they're able to fill these orders. by seeking out liquidity. So it's just basically like a pocket full of orders that they can see based off of market being moved towards a direction, because many retail traders would see this and be like, oh my god, if we can get a price to close above here, because many retail traders trade like support and resistance. I mean, depending on how far along your journey you are, like support and resistance isn't a bad way to trade, but you got a candle closure in here. Most traders would have seen that we closed above this point, and they would have wanted to enter to go long, and look what ends up happening, because instead markets hunted out the liquidity and didn't trade as a retail trader would. So why are we taking trades off of liquidity, and why is it that it's important to us? Well, obviously we want to be going in the same direction that the market is going, and who moves the markets? It's the banks. That's why we want to understand where these areas are, so we can get in at the beginning of the move. Once we understand liquidity was swept, we see a trend shift, a trend change. It's ready to go. We know where the markets want to go, because we'll be hunting liquidity. As I said on the daily, and how I explained it, is price sweeps, next candle opens, fails to take out the high but takes out the low, closes, being that we didn't need to take out the high and close higher. It's okay if we don't close below the low, as long as we don't close within this high. The trend shifts. Next day opens low, does not come all the way up to this high, but instead closes low and closes lower than the open of the low. The close of the low. Boom. This is just a gap in the market. We won't worry about that until tomorrow. We're trying to figure out those resting orders and where they are. We're trying to see market push to that price point. We're trying to see that there's a shift in the direction of the market structure, and if we don't see a shift, if bias doesn't match the draw on liquidity, then we just wait for a different approach. And being that this is the beginning of the beginner's course, I'll be teaching you guys much more things, but for today the lesson is liquidity and why you shouldn't take random trades, because the markets are moved by institutions and not our little micro positions. They're moved by massive amounts of money. Our goal is just to find it. And now once we have our liquidity figured out, the next thing to be would look for a rebalance. This is another important thing. I'll end the video on this note and continue on the next one. Is markets move for 3 reasons. Okay, let me move this over. Okay, markets, the hell, to hunt liquidity, like we just went over, to generate liquidity. Not all liquidity has to get swept. There's going to be points in time where I'll look for an example after and show you exactly what I mean. There's going to be points in the market where it'll leave a ginormous amount of liquidity behind, and that's where you'll see that it's generated that liquidity, it made it there. It's accumulating some form of later draw on that specific area. It'll become like very easy for you to find once I explain it to you guys, but for now let's continue on this topic. And last but not least, and we'll continue this segment right here into the next video, is to rebalance an inefficiency. Okay. Markets move for three reasons: to hunt liquidity, and like which we went over, to generate liquidity, which I'll show you an example of, and to rebalance an inefficiency. Our next video will be on inefficiencies and what this means. To generate liquidity, I'll just show you guys an example before closing this video out. But you guys might want to screenshot this and save this, and you'll understand why you won't just take random trades. Because if you're not seeing any of these three happening, it's kind of like pointless for you to take a trade, and you'll just be trading blindly. Okay, just take this out, and I'll show you. Let's look at the 4-hour. Here's an example of a generated liquidity. Here's another form of generated liquidity. These are 4-hour candles. So this day compared to here is about almost 16 days away. So here we have this generated liquidity. We have these. And we have this. This would be the most obvious draw on our liquidity. But being that we have this wick here, generated liquidity underneath, price comes up, sweeps a little bit out, heads lower. This place is lower. This is a rebalance and inefficiency, by the way. We'll go over that another time once we progress. I'll show you exactly why I use that example. It's a very good. I love that way of entering. It's kind of like how I base my entries on. But yeah, that's it for today. That's liquidity. It's a very important video. Hope you guys enjoy.